Welcome everyone. So
Perfect.
thanks Neil for having me on today. I appreciate it. Hopefully everyone's is enjoying their lunch. What I was hoping to do is just to start off with, just go over a little bit about who StoneCastle is and how we manage money, and then that will give you an insight onto, kind of what we see in the markets right now. So for those of you who are new to StoneCastle, we manage 5 different funds. So we manage a couple of equity growth funds, which is the StoneCastle Fund, and we manage for Purpose, the Canadian Equity Growth Fund. We manage an income fund for Purpose, which is the Canadian Income Growth Fund. We have a cannabis specialty fund, which we manage with our partners Spartan. And then we also have the StoneCastle Global Tactical Asset Allocation Fund, which we're just in the process of rolling out right now. And as you can tell by the name, it's an asset allocation fund with a go everywhere mandate, allowing us to be in all different asset classes at any given time. As far as performance, you can see the long-term performance of both the funds that we manage for Purpose, which are the prospectus-based funds. If you're looking for information on any of the other funds, StoneCastle Fund, which is our direct to investor fund, or the StoneCastle Cannabis Growth Fund, feel free to reach out to us. So as far as our process goes, we talk about it being definable, repeatable, and predictable. So definable in that we have strict criteria for why we're on offense, neutral, or defense. As well, we have criteria for why a company comes into or goes out of the portfolio. Repeatable in that we could take the data today, 5 years ago, or 5 years from now, and we would end up with a very similar portfolio. And predictable in that we can generate predictable attributes with our portfolio. We'd love to be able to generate predictable returns, but we know that that's not possible. But if we generate predictable attributes, that over a full market cycle, we will outperform. And that's really the goal of our portfolios, is to outperform our benchmarks over a 5-year period and to generate, good rate of return for our clients. So how do we do this? We start off with a top-down approach where we're trying to figure out whether or not we're on offense, neutral, or defense at any given time. If we're on offense, we're fully invested. If we're in neutral, then, quite often we have some cash in the portfolio. And if we're on defense, then we've got significant cash in the portfolio. We're looking at trimming back positions, possibly adding some, fixed income to the portfolios, having potentially some inverse or short positions as well. So we'll manage those three. We don't have to go from offense to neutral to defense. Quite often we'll go from offense to neutral back to offense again. And this really is dictated by our top down, which is market economic indicators and technical indicators. We do a webinar each month where we outline these and go in detail over all of the economic and market technical indicators. Helps you get a sense of really kind of where we're headed and what we're doing. So as far as the economic indicators, we use a number of different economic indicators, and what we're really tracking is rate of change of the economy. These aren't necessarily all of the ones that we use, but some of the ones that we watch. And we're trying to always figure out, how close we are to a recession and whether or not the economy is accelerating or decelerating, because that has a big impact on what happens with markets, with rates, and where returns get driven from. We have a number of different market technical indicators as well that help us to drive our decisions as far as being on offense, neutral, or defense. We look at different time frames. We look at short, intermediate, and long term, and we're really trying to spot the trends that are in place and participate in those trends, whether or not it's up or down in the market. As far as sectors go and what we do there, we take a look at the sectors and we rank order the sectors as far as favorability every single day, so we know which sector has the strongest attributes, both from a technical standpoint but also from a fundamental standpoint. And we see this in our work both from the top and the bottom. When we dig down into company specific, what we're looking for pretty much in in all of our funds, with the exception of the asset allocation fund, is we're looking for companies that have some sort of catalyst in their business that's going to accelerate their growth profile, both from a revenue and from an earnings standpoint. We want companies that have that accelerated earnings growth, and at the same time, with our income portfolios, we want companies that have lower than market beta and higher than market dividend growth. And then we're looking for for valuation. So we want to see reasonable valuation compared to the growth rate, compared to the market. And then the last thing that we want is we want the market to recognize what we recognize. We often are not going against a trend and buying something as it's dropping. Historically, we've always bought after the first catalysts have sort of shown up, and the longer term trend is in place. How do we do this? We rank our universe every day from 1 to around 1,000 in Canada. It's around 4,000 in the US. And we look at it both from a fundamental standpoint as well as a technical standpoint. We'll look at the individual scores. We'll also look at the technical scores, and we can see these things change day by day as different factors happen. If they report earnings, if analysts are revising up, if the stock price has moved a certain direction, and that will have an impact on where it is in our portfolio. We have a certain level where we want to hold that stock to. If it drops below that level, then we're looking to replace it with something that is accelerating at a little bit faster growth rate than what we have. As far as the sell discipline goes, everyone has fairly good success buying. Selling is really where things get differentiated, and we like to try to use as much of a systematic approach as we can. So we've got a number of different sell disciplines that we put in place. When stocks hit those sell targets, specifically on the downside, not so much on the upside, then at that point in time, we're reevaluating those stocks, taking a look to see whether or not we should still be holding them, whether or not there's catalysts, and whether or not there's something that we're missing in the stock price. So this is sort of really how we manage money. We think that it helps us to differentiate ourselves. We think that in a lot of cases we're looking at areas, and we're really pulling out companies that typically are flying under the radar. It's really less competition in this area. That's been the case over the last probably decade, as compliance has become more difficult for your average investment advisor and portfolio manager. And that's what's allowed us to have long-term numbers that have been able to outperform the markets. As far as where we're at right now, when we look at kind of everything, first thing we do is we break down our asset leadership model. So what we're trying to do is figure out what the top asset class is: domestic equities, foreign equities, cash, fixed income, and commodities. Right now, you can see with the two boxes there from Q4 of last year to now, really there hasn't been a lot of change. The positions have all held the same. Cash started to make a move and rose up a little bit in the fourth quarter, and foreign equities started to drop. We've seen the foreign equities actually in the last few days showing some improvement. If we look at asset class, you can see not just domestic equities, but we look at the different size, so small, mid, and large. And you can see right now that really it's been a large cap driven market for the last year. Fixed income really hasn't been super strong with rates going up. We continue to see that weaken, which is quite interesting. And then from a commodity standpoint, we've seen oil quite strong, continues to tip highs that we haven't seen since back in sort of 2014 range. We've seen the base metals showing some improvement. Copper and nickel certainly haven't been running away, but they've been fairly stable here, and with a rising trend. And then precious metals, that's been a very challenging market for a lot of people. Precious metals had a nice move into the mid 2000s, and since then have really been pulling back. We've recently seen, looks like, a bit of acceleration in gold again. And then the US dollar is obviously a big factor, drives where things go. We actually think that we were probably entered into a new commodity cycle. We were sort of talking about this over the last year, where we think that the ratio of the commodity index to the Dow Jones has really bottomed the same place it did back in sort of the late 90s, early 2000 range. And what we saw a significant outperformance of the TSX over that period of time, because we are so heavily weighted to commodity stocks here in Canada. So just as an example, from 2003 to 2007, you can see how returns shook out. So the TSX was up over 140% versus what we saw in emerging markets, and then the S&P itself. So it could be quite a good time if we see this shift for the Canadian market. Where are we seeing things from a country perspective? This is looking at different country ETFs on the right hand side versus the overall or versus the S&P, and you can see that there's a lot of relative strength building. This is a relative rotation graph. Stocks, any type of securities go around this in what tends to be a clockwise fashion. And you can see that after a period of weakening and lagging, there's a number of different countries, ETFs that are improving versus the US. Right now, Canada is in the number 7 spot behind a few other countries. So we do think that Canada continues to improve, and it seems like there has been a bigger shift in what the market's looking at on this growth to value swing. If you again look at the relative rotation graph for the US, all the growth indices are heading towards that lagging quadrant, whereas the value stocks are heading towards, or they're in the improving and heading towards the leading. So we really feel that there's an opportunity there where the market's shifting what it's looking for, and it's looking at those financials, the energy stocks, the mining stocks, a lot of what's been weaker in the last probably year or two, and certainly been in a trend where the US growth stocks have been outperforming for really kind of the last decade. That could be coming to an end here, and it's something that we're watching quite carefully. Last year, we really saw it was a year for small cap value over small cap growth. You can see the returns here if you look at the US. Small cap value, which when you include a number of those sectors I just talked about, financials, energy, materials, was up close to 28%, whereas growth was up only 2.5%. So that trend started last year, and it looks like it continues to emerge this year. The TSX small cap, interestingly enough, it really was range bound last year. Throughout most of the year, it stayed within this range. We're at the upper end of that range right now, and it's actually breaking out versus the US Russell 2000, which is often referred to as their small cap index, probably a little bit different than Canada, and certainly has a different makeup as far as the number of the type of companies that are there. And so we are seeing the TSX, which is again small cap index, is more weighted towards precious metals, base metals, and energy, and it's had a fairly good move here, especially for the first part of this year. As far as looking at kind of overall risk of the market, I know the market's been really choppy here the last few weeks. We're thinking that there is a bit of transition going on. There's lots of talk of rates and inflation, but interestingly enough, one of the trend breakouts that we've just recently seen is emerging markets versus the S&P, and this is when this line's moving up, the emerging markets are breaking out, and you can see they broke this trend line that goes back over the last year, and that tends to coincide with high beta, low beta volatility, and where the markets are headed. And so what we're expecting is that this is a correction. Corrections are never fun, never comfortable, but they are kind of normal parts of the market. And once we probably get through this, where the markets are getting a better sense of what the Fed's going to do, where they potentially are going to move rates, and how many rate hikes they do, at that point in time, then we should probably see some type of reacceleration. In the past, when we've seen a real risk-off move where there's been a financial crisis or concern, the emerging markets typically are selling down. In addition to that, you also would see in sort of a traditional sell-down market, you would see credit spreads weakening as well. So this is looking at the high yield versus the 20-year U.S. Treasury, and if we started to see this line deteriorate and start heading down to the bottom right-hand side of the chart, then that would indicate that we were seeing relative strength move into the higher grade bonds, so into the U.S. Treasuries, as opposed to being in high yield. And we haven't really seen that to any great degree. There's been some volatility in the high yield, but it hasn't completely broken down. Lots of people ask sort of what happens with interest rates and where do we go from here. So we just took a look at what happens with our Purpose Canadian Equity Fund the last 3 times since we've been operating the fund, that interest rates have gained more than 100 basis points. You can see that S&P had fairly strong returns over the next year. The TSX had pretty strong returns, and our fund also had positive returns over the 3 timeframes that we're looking at. TSX, where are we at right now? I know that obviously there's lots of Canadian-centric investors, so they're always kind of looking. We see a lot of the securities over on the right-hand side of this axis. So in the leading and weakening quadrant, energy is showing up in the weakening, but it's actually hooking and heading back up into the leading quadrant right now. And a lot of the kind of more traditional defensive sectors, so utilities, consumer discretionary, consumer staples, and financials are in this area right now. What are we seeing deterioration in? Technology has been kind of one of the big movers. It's in that lagging quadrant, and healthcare, which is really the cannabis stocks, have really been in that lagging quadrant for quite some time, and they continue to be weak part of the market. We do an overall risk assessment of the market and try to determine where we are. So if we go back to August of last year, there was a bit of volatility back then. We were sitting, in a neutral position. We've now moved to kind of that neutral offense. We still are, have to stress that neutral is there. We're seeing some positive signs, but what are we watching? We're watching the US dollar. It was stronger. It's pulled back of late. It's been a little bit weaker. That could present, if that continues to weaken, present a strong opportunity for both commodities and the overall markets. Interest rates, we're watching what happens with interest rates and inflation, and those will probably go hand in hand. If we started to see some type of inflation drop, then at that point in time, we would start to see, interest rates probably tapered back a bit. COVID will, we'll obviously see some factors that have an impact on economic numbers. We're starting to see that right now from the recent bout of the latest strain, and that'll have an impact on economic numbers and where the market sees things going, and then market breadth and sentiment. And interestingly enough, if we look at sentiment right now, it is tracking fairly low levels. So there's a lot of information here, but on this top graph here, we're just looking at the National Association of Active Investment Managers, and anytime that we sort of drop below that kind of 50 range, we think that it really signals that sentiment is washed out. We're not there yet, but this data is also a couple weeks old. If we look at the AAII numbers, same thing with it. We've just recently seen one of the most bearish readings in the last year. So sentiment certainly is on the weaker side, and we know that you can't time the market perfectly with sentiment, but certainly it both on the upside, and on the downside, it gives you an idea of where things are at. Now, why do we think there's an opportunity now? Well, we know that the smaller mid-cap stocks have gone sideways for the last year. Again, we looked at our Purpose Canadian Equity Growth Fund, and we looked at the last 3 times we had negative performance versus the market. So we underperformed the market, which was 2012, 2015, and 2018. And we can see what happened the next 2 years following that. We had very strong returns, outperforming the market. We just had we had a year last year where we underperformed the market in 2021, and so could 2022 to 2023 produce similar type of returns? I'm going to be back after the companies present just to talk a few stocks. In the meantime, if you have questions, if you'd like to be on our distribution list for our monthly indicator update, feel free to send us an email. And Neil, I'll hand it back over to you.